Welcome to the final week of Biz Wire. I'm Joseph Nordstrom in Beijing. Last week, investors in the U.S. renewed their vows in China's continued upward momentum. E-commerce portal JD.com listed its shares on NASDAQ, raising the company's coffers by $1.8 billion. That values the firm at over $25 billion, even higher than Twitter when it debuted late last year. While $25 billion is nothing to sneeze at, it pales in comparison to China's next big IPO in America, Alibaba. If shares go on sale at the top of their range, Alibaba could be worth as much as $200 billion, making it one of the world's largest companies. E-commerce in China is already equal to or higher than online sales in the U.S., and is projected to grow 27% per year for the foreseeable future. JD's business model is often compared to Amazon's, as the company is a direct seller of goods and holds much of its own inventory and has an in-house logistics network. Alibaba, on the other hand, acts as a middleman, bringing buyers and sellers together, and is a much less expensive model, giving the company fat profit margins. They're competitors, but with online sales expected to surge past $300 billion this year, there's plenty of market to share. Besides currently dominating sales, Alibaba is also a pioneer in payments, loans to sellers to expand their businesses, and finance, offering above-average rates on its money market fund. JD, along with its investor Tencent, is also moving into these areas. Perhaps the most exciting part of JD's business for investors is in mobile sales. Slowly but surely, JD is integrating itself with Tencent's mobile app WeChat and its 400 million active monthly users. Now, China's e-commerce is now a global phenomenon. For now, they might not affect eBay or Amazon in the U.S. and Europe just yet, but they are marching out into the growth markets of Southeast Asia and beyond. With their newly revamped war chest and experience in the world's biggest e-commerce market, Alibaba and others will have the means to expand their footprint. Much of China already has world-class infrastructure, but e-commerce companies, including Alibaba and JD.com, lack the warehouse and logistical facilities to enable what some call the holy grail of online shopping, same-day delivery. Each has already made substantial investments in this area, but much more will be needed as competition gets even hotter. Investors have good reason to be very interested in these two e-commerce titans, but will this extend to other sectors of China's economy? After a series of accounting scandals, investors may still be skittish towards Chinese stocks that have largely avoided U.S. listings the past 3 years. Disposable income in China has reached a threshold where consumer spending is now driving most of the country's GDP growth. This segment of the economy is likely to continue growing as official policy is fully supportive, as is China's younger generation, who is much less prone to saving than their parents and much more likely to seek instant gratification, which online sellers and global investors are more than happy to oblige. You're watching the final week of Biz Wire on China's Blue Ocean Network. Our full episode can be seen on our website, BONTV/biz-wire. Let's turn now to Neil Jones for a quick look at a few stories that are buzzing through the markets.